Hello YouTube, Cancerman COINTELPRO. Doing a response here to Montagraph. And I really wanted to because he was talking about some things about Bank of America that I thought were pretty interesting. Talking about the market in general. And he mentioned the term penny stock, which is very interesting. I wanted to touch on that. I wanted to kind of elaborate on that. A penny stock is a stock that trades on the over-the-counter bulletin board or the pink sheets. These stocks are usually uh, they're valued per share at $3 or less than $3 per share. And you are correct, Montagraph. Definitely, Bank of America is actually close to becoming a penny stock. It looks like it closed at $5.77 today. Looks like the day high. It was actually up 1 cent on the close. The day high was $5.83. The day low was $5.51. Okay. Looked like the volume on it was 291,785,613. That's the total number of shares that traded today. Now this is something that's very interesting. I really want to discuss with you guys, and I want to look at this. The 52-week high on Bank of America is $15.31, and that was on January the 14th of 2011. The 52-week low on Bank of America, now get this, $5.13 on October the 4th. January 14th, it was at $15.31 per share. On October 4th, it was at $5.13. That is profound, to say the least. Absolutely. But I wanted to let you guys know, of course, with the way the market works. What this price is dictated is not really the company itself. It has to do with people's perceptions of the company, but this is really based on trading activity. So what we're looking at right now, being that it dropped more than $10 per share between January and October of this year, the people in general are selling Bank of America. Everyone is selling it, not just people, institutions are as well, because of the perception that Bank of America is not going to earn money moving forward. Now, do you remember the derivatives market that I was explaining to a lot of people before in one of my New World Order videos, where I mentioned the tail wagging the dog? There are a lot of options contracts on Bank of America right now, absolutely. One of the things that can actually drive a stock's price down considerably is if mutual funds sell that stock, decide they no longer want to have that stock as part of their portfolio in that fund. If the fund manager decides that company is no longer viable, that can have a tremendous impact on the performance of that stock for individual investors. So Bank of America really isn't losing anything when their stock goes down, other than the notoriety. They lose that. They lose that persona, so to speak, or that. When a company's stock goes down, it does reflect on the company to a degree. It kind of hurts their bragging rights. If you look at Google, for example, let's bring them up. Google closed today at $504.70. Now, Google's a very expensive stock. Apple is too. Apple's a very expensive stock. And basically, it keeps people from wrecking it as much. People are not day trading Apple and Google. Well, some people are. People that have millions of dollars are. But it's just not viable for someone to day trade Google, so to speak. That's usually something that people would buy and hold on to. They're looking for a capital gain over the long term. As far as Bank of America, they're no longer viewed that way. They're no longer viewed as a stable company. And I think a lot of what Montagraph was talking about, I think it has a lot to do with it. the fact that Anonymous has hacked them, the fact that Anonymous has targeted them, and that they have been hacked successfully, though it was just a denial of service attack, it was relatively successful. A lot of it, though, a lot of this is based on people's views toward banks. Let me take a look at something else. Citigroup's not going to work too well for this, just because Citigroup did a stock split. I mean, I can still do it, but I'm not going to calculate it right now. I'm going to look at JP Morgan, because that's another bank that Montagraph mentioned in one of his other videos, as far as JP Morgan giving money to the New York City Police Department. They actually closed at $30.84 today. They were up 58 cents. That was 1.92%. They had a pretty decent day. Let's look at a detailed quote on JP Morgan. All right. We're probably not going to see the same things on JP Morgan that we saw on Bank of America. All right, here we go. All right, today's high was $31.17. Today's low is $29.40. So it did move around a bit today. There's not much volatility on JP Morgan today. The 52-week high on JP Morgan is $48.36. That's the 52-week high. That was measured on February the 16th of 2011. The 52-week low on JP Morgan is at $27.85. That was on October the 4th. So we're actually looking at a lot of these banks specifically, and they're actually just reached their 52-week lows within the last several days. And people blame the crisis in Europe and things like that. A lot of it has to do with perception and the way people are perceiving them. We have protests going on Wall Street right now. Public opinion is not in favor of the banks right now. It truly isn't. And while JP Morgan dropped close to half, just a little bit less than half, so it dropped close to 50%, that is nothing compared to Bank of America, which dropped nearly 70%. I mean, that's considerable. That is very, very interesting. But one thing, the way these trade, they're traded on the secondary market, so it's based on public opinion and the way the investor perceives that stock as far as how healthy the corporation is, whether their friends told them to buy it, whether, Mad Money, oh, who's that guy? What's his name? Whether Susie Orman tells them to buy it, whether, I can't believe Bill Kramer. Jim Kramer? Bill Kramer? It's Jim Kramer, I'm sorry. Whether Kramer says to buy it or not. A lot of people will base their decisions on that. The thing is, when a company does a public offering, whether it be an initial public offering or whatever, the company comes out and says, we're going to sell this number of common stock shares, on this date. We're going to offer this price for it. And that's the extent of the company's involvement. So Bank of America says, we're going to do a public offering. We're going to sell 100,000 new shares at a subscription price of, since it's $5.77, we'll say they'll do it at $6. You can buy this stock at $6 if you take part in this initial public offering or IPO, or what wouldn't be considered an IPO. But either way, that company collects those funds off of the sale of those common shares. That's the extent of their involvement. Once they do that, once they sell that, they're no longer involved. The transfer agent takes it and it gets released onto the market, and people buy it on the market. So if you buy 100 shares of Bank of America tomorrow, you're not buying those shares from Bank of America. What you're doing is you're buying those shares from another investor who is selling those shares. Somebody else has decided they no longer want to own that stock, so you're buying their shares. Or the broker that you go through, or the transfer agent that was assigned to that Bank of America chose to handle their common stock, offerings, you buy shares out of that. Now, Bank of America can buy their own shares back off of the market, and they put them into what they call the treasury, the company's treasury, which is where they can go out and they can buy their shares back and they can hold them. And of course, treasury shares don't pay dividends or anything like that. They don't hold voting rights for the board of directors. So that's another thing to keep in mind. A lot of these companies will, it has been done in the past. I'm not going to say that's what Bank of America is doing right now, but it has been done in the past where the leadership of companies will do things to intentionally drive the stock prices down so that that company can buy their shares up on the open market and put them into the treasury, resulting in fewer shares outstanding. And what that does is that transfers a large portion of the ownership of the company back to the company. When you have a publicly traded company, it's a publicly owned company. When you buy a common share, common stock, you're buying equity in that company. You're buying a little piece of that company. So in doing so, they can actually put these shares back into their treasury to where it's no longer owned publicly. Now they can sell those back out of their treasury if they choose to, or they can use those shares to put in their employees' accounts, their executives' account. And if they buy these shares up on the market at a lower price, then they've cut a lot of costs by doing that. And they can also wait until the shares come up in price and sell them again and be able to put more money into their reserves. So this is very interesting the way this works. And I'm really glad that Montagraph brought that up, because the fact that he did does prove to me that he does have a pretty good idea of what's going on. And I applaud you for that, Montagraph. I truly do, because there are so many people on here who discuss these things, don't even know how it works. And the fact that you mentioned penny stock, that this company was close to becoming a penny stock, that was a wow moment. I actually sat back, I was like, this guy's pretty intelligent. He has a pretty good idea of what's going on. So I just really want to touch on the penny stock to let people know exactly what it is that you're talking about. That Bank of America is in danger of their share going below $3 in price. And that is what, in turn, penny stock is. You have three levels on the market. Well, you have more than three, but you have the penny stocks, which are the bottom, the over-the-counter bulletin board. You have NASDAQ, and you have NYSE listed securities. Penny stocks are at the bottom. They're basically companies. A lot of the companies that are on the penny stocks are in default. When GM went under, and they didn't go under, but when they filed bankruptcy and they started trading under the symbol MTLQQ, which is Motors Liquidation, that was actually traded on the pink sheets, which is penny stocks. So that's how profound that is, what Montagraph was talking about them becoming a penny stock. That's what he's talking about. The company losing so much notoriety and so much respect in general on the markets and the industry in general, that they are in fact in danger of being traded on the over-the-counter bulletin board or pink sheets. Either way, I can discuss this in some more detail. I'm going to upload another video, where I discuss the markets really quickly. It'll be a very quick video, because this one, actually I'm going to do it right now. I got a minute left. I think I can do it. Okay, so what you have is you have the pink sheets. They have no minimum listing standards. You do not have to have minimum numbers of shareholders or minimum amounts of net assets. Your books do not have to be in order on the pink sheets. To be on the NASDAQ, your books have to be in order. You have to have minimum numbers of shareholders, but they're not New York Stock Exchange traded securities, so they don't have that. They don't have that sort of notoriety at that point. The New York Stock Exchange is one of the best places to be, because that means that your stock is big enough and your company's big enough that you can trade with the big boys on the exchange. If you can get onto the Dow Jones 500, or excuse me, the Dow Jones 30, not the SP 500, but if you can get into the Dow 30, that's a pretty big damn deal. That's like the elite of the elite of the elite as far as the manufacturing is concerned in this country. But I'm going to go ahead. I'm going to end it. This is YouTube Cancerman COINTELPRO, still the unknown variable 6. If anybody has any additional questions, just send me a message or post a comment, and I'll answer them and do another video if needed. But have a good one.